Hi, this is Ron Janish from andrewscourse.com, and today the focus is on combining lagging and leading indicators. Okay, first of all, let's take a look at a lagging indicator or two. This line here, this pinkish purplish line, is a 200-day moving average, and this is the S&P 500. And this blue line here is the 50-day moving average. Now, there's several theories regarding this. Uh, One of them is what I call herd theory, that if you chart these lines on your screen, you'll have a better understanding as to what the herd is doing and to what the herd is thinking. And so here, for example, one of the theories that the herd really likes is that when prices are above the 50-day moving average, which is above the 200-day moving average, then there's going to be a nice strong move. And obviously with 2020 hindsight, we can see that. Okay, we can see that a nice strong move took place above the 50-day when it was above the 100-day and above the 200-day moving average, above the 50-day and the 200-day moving average rather. Okay, so, and one of the other things the herd likes to focus on is that when the 50-day moving average is above the 200-day moving average, that's when there's going to be a strong move to the upside, and when the 50-day moving average is below the 200-day moving average, there's a nice strong move to the downside. Does that work? Yes, it does. In the S&P, it has something like an 70-80% correlation. So it's reasonably accurate. However, the question is where do you get in sometimes, and can you do it with a reasonable risk? And because you may start on a day like over here, and what do you do? Do you just jump in and hope that it's going to go up from there, or do you wait until something more favorable comes along that gives you the opportunity to profit from a quick move? Okay, and so one of the things that's different about Andrews versus moving averages is that Andrews uses geometry. And with geometry, you can put up some really cool leading indicators, and you'll have a leading indicator because with this much data, as you can see here, you can project that, gee, if prices go down here, they're going to be hitting the area of a 200-day moving average and a median line. Okay, so one of the things you want to look for is prices reversing at or near a 50-day moving average and a median line or median line parallel. Actually, you can go beyond that. You can go, let's just call it a course indicator. That would indicate a turn is probable. Let's take a look. So you can combine this here, and you see how nicely this worked? Okay. Boom, what a nice move to the downside. Now, when you see a nice move like this to the downside, of course you use the course methods to determine when to exit the trade. Okay, but from a risk point of view, entering in this area here is rather nice. Okay, and the same thing comes over here. You're looking for prices to hit the median line or the parallel and one of the two moving averages on the same day, and ideally be in sync with the 50 and 200-day concept. In other words, for a long signal, ideally looking for the 50-day to be below the 200-day moving average, and that's for a short signal rather, and for a long signal looking for the 50-day to be above the 200-day. Okay, so because that's what the herd is doing, that's what the herd is looking for, and so whenever there's positive news, they really go for it. So here, take a look here. Prices go down to the ML, do a nice bounce, boom, and up we go some more. Okay, and we have the same kind of thing here. Okay, here we have another example. Now, let's take a look at what's been happening recently. We can see that prices went down here. We had an ORA. We had several indicators coming in right here, and this helped us get in way down here. And those of you that might have used this kind of thing might have waited until they jumped up above the 200-day or something. Uh, you would have made a nice profit on the up move here. And there are those that like to use this on an intraday basis also. Let's take a look. Okay, this is a 65-minute chart in the SPY, and we can see that prices did go down to the ORE, and had somebody use this nice little intraday chart with the median line, you'd see that prices went to a far parallel on this line here, right? Really nicely, and it was right by that, right around the same time it hit that 200-day moving average, and we see the 50-day is above it, right? Okay. And now personally, I don't necessarily use this particular concept of adding the 200-day and 50-day because I use course indicators, which are kind of neat. And so here, for example, we have prices coming back up to the 200-day. I'm sorry, back up to the 50-day. And so if you were long here, this is not a bad place to get out, as they jumped up and opened up near the far parallel and jumped up right by the 50-day or 50 bar moving average. Okay, so this is to give you a nice quick idea of combining the moving averages, which are lagging indicators, with leading indicators like the median lines and other geometric type things. Okay. Now, as we look at the market now, we can see that prices briefly spent some time below the median line and did their quick jump above it, and now have the opportunity to go down quite a bit more. So what I suggest you do at this time in order to understand the other course concepts is type in www.andrewscourse.com, then click on products and take the Advanced Andrews course. You'll get 25 videos or more that you can watch, along with a nice extensive color manual, and you'll wind up being in a really cool group that gives you insights and answers to your questions. So, without further ado, I thank you for your time and see you in the course.